Hi, everyone. Thank you for joining today's webinar. My name is Dave Mantell. I'm a certified financial planner and partner with Stabler Wealth Management, and I'll be your presenter today. At Stabler Wealth Management, we're an independent financial planning firm and specialize working with Boeing employees. For today's presentation, we'll cover how to successfully retire during uncertain times. We'll review the challenging markets we've gone through so far this year and how to best navigate as you prepare for your own retirement. For today's agenda, we'll have three main topics. The first topic we'll cover is the importance of matching your investments to your own personal retirement income plan. Next, we'll look at why this could actually be a great time to retire, despite all the uncertainty out there. And then finally, we'll hit on our bear market playbook and strategies to take advantage of the current turbulence in the market and the economy. Before we jump in to tell you a little bit about us, we have a team of certified financial planners here at Stabler Wealth Management. We specialize working with Boeing employees and helping our clients prepare for and transition into retirement. And in addition to managing our clients' investments, we provide holistic financial planning advice to help our clients achieve their financial goals. You can find more information about us at our website, www.planyourboeingretirement.com. Something to note, whenever you're working with a financial planner, advisor, getting financial advice, we always recommend you work with a fiduciary. A fiduciary is required by law to act in your best interest and be on your side of the fence in a sense. At Stabler, as certified financial planners, all of our advisors are fiduciaries. So to kick off our presentation, we'll start talking about matching your investments to your retirement income plan. So as noted, we're going through very uncertain times. Between 40-year highs in inflation, the Russia invasion of Ukraine happening earlier this year and continuing to be ongoing, rising interest rates, and a bear stock market. This has been the worst stock market start to a year going back to 1970, if you look at the initial 6-month period. And so in all these times of uncertainty, one of the real staples of success in retirement is making sure that you align your investments with your retirement income plan. So retirement income consists of a few different aspects. You have your Social Security, you have pension income where that applies, and then you take draws from your 401k and investment accounts to bridge the difference of your income needs. So when investing for retirement, it's critical to make sure that your investments are really specific to your personal retirement income strategy. And we're looking at the time horizons for when you need that income, the timing, and how much. And that'll really drive much of your investment decisions. So for example, more short-term money, for example, if you needed $30,000 for a new roof in the coming year, you want to place that money in something very secure and safe, where you know it'll be there when you need it. For money that you're not going to touch for the long term, 7, 8, 9, 10 plus years, that you could handle some more volatility as you're looking for more growth with that portion of the money. And so just like that roof example, the same goes when you're thinking about retirement planning. We like to divide your portfolio into multiple buckets, more short-term, intermediate, and long-term, and then matching your investments to those specific buckets for your own plan. One of the big items you'll hear about and one of the risks with retiring is something called sequence of return risk. And what that means is what happens if right when you retire, you hit a real down stock market. And so right off the bat in those early years of retirement, your accounts and balances go down and you worry that you don't have a chance to recover now that you're in retirement phase and taking out money rather than contributing to your investment accounts. As shown on this current graph, here's a really good example where the sequence of return risk applied. So if you look at the period between 2000 and 2015, we had two massive pullbacks in the stock market during this 15-year stretch. And so where the sequence of return risk applies is if all of your money is invested in the stock market, and let's say somebody's retired, as we go through a big drop like we saw through 2000, through early 2002, 2003 even, what would happen is as a market's dropping and you're needing to access your accounts in your portfolio for income draws, you're having to sell low. And the money that you're selling, the stocks that you're selling at these low prices for your draws, therefore cannot recover. Likewise, as we went and saw the market come back up again, going through 2007 into the start of 2008, we then had another really large drop thereafter. And so this could be a very difficult stretch for that example, where investors who were not positioned appropriately were not able to withstand the big volatility and the havoc that could wreak on your accounts and portfolio if positioned in the wrong manner. So while what I just went over is some of the risk of the stock market and the timing of retiring, despite that, stocks still have a tremendous history over the long term of performing and being a tremendous wealth builder. And so while the short-term investments, as we went through that roof example a couple of slides back, you want to make sure you have funds allocated to a real income-oriented, less volatile allocation portfolio where you could therefore tap draws for the short to medium term. Money that you're not going to be touching for the longer term, 7, 10, 15 plus years, can be much more growth-oriented. And even though that can come with volatility, that's a long time horizon on those funds. So you're not forced to sell at the temporary downs that are going to occur from time to time. And so while stocks, again, can be very volatile, as shown historically, they in our view, are the most powerful wealth builder. And to be able to maintain your principal and keep up with inflation over time, we do think it's really necessary to have that growth aspect to your portfolio as well, just in the right sizing, and make sure you're marrying your income strategy in alignment with your investments. A lot of folks say, well, now that I'm retiring, I don't have to worry about that long of a time horizon. I'm through a good portion of my lifespan, and so now I'm just focusing on that final third or final 40%. And an interesting factor is as we see people continue to live longer and longer, now more than half of couples out there that are over the age of 60, at least one spouse will live at least to age 90. And so for somebody retiring at 60, that still could be 30 plus years that you need to prepare for to sustain income and live in retirement. And so even folks that are now entering retirement or in retirement, we still strongly believe there is a longer term time horizon in addition to the more short and midterm where you'll be drawing income from. So while I just went over some of the risk of the stock market and the volatility that comes with it, as I also noted, the stock market has been the #1 wealth builder over time in our view. And therefore, despite all the uncertain times and volatility that comes with it, it really in our minds is a staple of clients' portfolios. And so here's a good example. A lot of folks are comparing this period that we're currently in into the 1970s, where we had, sustained high inflation, high rising interest rates, recessions. This time's quite a bit different in our view, but we are seeing some similarities with the rising inflation and rising interest rates that we haven't seen to this extent for, many decades. And so in 1970, if someone started with $10,000 in the stock market in the S&P 500 and held on to that through today, and so that includes recessions, 2008, 2009 crisis, COVID 2020, going back to the 80s, Black Monday crash, a lot of different events that have happened over that time. And despite all the volatility and the multiple recessions that we're seeing, that $10,000 in 1970 would be $2.2 million today in the stock market. $1 million would be 220 million. And so of course, the purchasing power has gone down with inflation. And so a dollar in 1970 is not the dollar today, but that still demonstrates a massive wealth that can be created from the stock market and the tremendous history of keeping up with inflation and keeping one's principal up if you can weather that volatility. I've mentioned inflation a few times on this webinar so far, and it's been a really hot topic and headline grabber as of late, as we've seen the highest inflation numbers we've had in 40 plus years, getting north of 8-9%. And so high and rising inflation presents a lot of challenges, especially for savers and retirees, that we haven't really dealt with much over the last 40 years. Now, while inflation can be concerning as you lose purchasing power and your dollar buys less over time, there are several tools to navigate inflation that we do have in the toolkit. And we view that for every investor, especially as we look forward over the coming decade and beyond, having some of these inflation hedges and inflation sensitive tools in there can really result in a more smooth, less volatile investment returns and a more smooth and comfortable retirement as a result of that in lieu of those returns. A few of the different tools when we think of inflation that we speaking of is using inflation-linked bonds and short-term bonds for some of your more short, medium-term, intermediate time horizon investments. Commodities and precious metals are two asset class groups that did really well in the 70s, for example, during that high inflationary period. You can complement your more traditional holdings. And then lastly, there are certain stocks, such as energy stocks, for example, that can do well in a high inflationary period, while other stocks, as we've seen with technology at times, can struggle during periods of sustained inflation. So for the second portion of this presentation, we'll hit on why this can actually be a good time to retire from Boeing, despite all the uncertainty that we noted. And so the primary reason for this is there's a way for Boeing retirees to really benefit from last year's historically low interest rates. So if you go back to 2020 and into 2021, as response to the COVID crisis that was faced in the initial stages of the pandemic, we saw the governments across the world really lower interest rates to help energize the economy. And as a result, segment rates, which is the primary driver for determining lump sum payments for Boeing employees, were also at historical lows through the end of 2021. To benefit from these low 2021 interest rates, so remember the lump sum calculation, as I've mentioned on other webinars and presentations, is based on the prior November segment rates. So anybody retiring at any time in 2022, the lump sum calculation is based on the November 2021 segment rates. So even if interest rates continue to climb throughout the year, that does not impact the calculation for 2022 retirements for those taking the lump sum. And so based on today's rates, those that retire next year in 2023, for example, could see a dramatic reduction in lump sum payouts versus a 2022 retirement. In some cases, we've seen as much as a $250,000 drop in someone's lump sum simply from retiring in December 2022. Instead, retiring in January of 2023, you'd see that big reduction. So again, retiring any time in 2022, including the beginning of December, you would be using the more favorable 2021 rates. So that'd be a higher lump sum payment. If you retire in 2023, even as early as January, you're going to be using the 2022 segment rates. So that's where we've seen these dramatic potential declines. And it's worth noting, we do not yet know what the November 2022 segment rates will be, of course. However, we are able to see, through April and now May and June, the way interest rates are tracking. And as we get closer and closer to the end of the year, we'll be able to provide a more clear estimate on what we think folks' lump sum pension payouts will be next year if they retire in 2023 as opposed to 2022. And so why this could be a good time to retire and take your lump sum is that the lump sum pension payout occurs in cash. And so no matter what the stock market is doing, that has no impact on what your lump sum payout is directly. And therefore, even as we've seen a sizable pullback in the stock market through the first half of the year, your lump sum payment is the same, now as it essentially was 6 months ago. Aside from a few variables such as your age, but largely the same, even though the stock market has dramatically gone down. Therefore, this is a good time to potentially retire, receive your lump sum pension if you're going to go down that road, and then you have access to a large, amount of cash that can be available to buy low potentially, as the stock market's quite a bit lower today than it was at the beginning of the year. So keep in mind, everybody's situation is different. And so we do recommend you meet with a certified financial planner before making adjustments in your portfolio or deciding a retirement timing. But again, this could be a really good time to trigger in your retirement, where you'll receive a higher lump sum payment likely than you will likely in 2023. And then two, you're receiving that chunk of cash now at what could be potentially a good entry point into the stock market, as we've seen the market quite a bit lower than it was, even 6 months back. So for the third leg of our presentation, we'll be hitting on our bear market playbook. And so to define a bear stock market, so what a bear market is when the stock market declines more than 20%, you are now in a bear market by definition. And so we've seen the S&P 500, as well as most stock market indicators, drop over 20% this year from high to low. And therefore, by definition, we have entered a bear market at this point. And so while bear markets can be very uncomfortable, especially when you're nearing and approaching retirement, they do present some very good opportunities to take advantage and maximize for that volatility and the turbulence, especially as we have our eyes on a long-term picture and a long-term financial plan. The first, method in a bear market is looking at tax loss harvesting. So in non-retirement accounts, after-tax accounts, you can look at your investments, and during volatile times, some of your positions may be temporarily down with the stock market. And what you can do is sell those positions in a non-retirement account, capture and realize that temporary loss, and then reinvest in a similar like position, or use that as a method to rebalance. And then you still have that access and exposure to the market for when you anticipate it will go up at some point. And so tax loss harvesting can be a really good technique. You do need to be cautious of what they call the wash sale rule. So you have to wait 31 days from selling an investment to buy back that same investment. That doesn't mean you can sell, one fund or ETF index fund and purchase a similar fund, but to buy back the exact same fund or the exact same stock, you'd have to wait 31 days to do that. Another strategy to consider during bear markets as we're going through is Roth conversions. So what a Roth conversion is moving money from your IRA, which is a pre-tax investment retirement account, to a Roth IRA, which is a tax-free account. And so what would happen is when you convert money from your traditional IRA or 401k to the Roth IRA, you would be paying ordinary income tax now on the amount you convert, since you're moving it from that pre-tax bucket to the tax-free bucket. However, once it's in a Roth account, all the future growth occurs tax-free. And so with the stock market down and folks' retirement accounts lower, it's a great time to be looking at possibly doing Roth conversions, because then the ultimate bounce back in the market, when we expect that to occur at some point, happens tax-free in the Roth account, rather than growing in the pre-tax account where all the gains are subject to ordinary income once they're captured. And so that makes it a really prime time to be looking at Roth conversions. Roth conversions can be complex. Again, it's a taxable event and can trigger other considerations. For example, for retirees, it could impact your Medicare premiums. And so again, we do recommend reviewing this with your financial planner before putting in place, but something that's definitely an opportune time to look at. Likewise, during times where the market seems very high or where the times where the market's lower has pulled back a bit, that's a good time to potentially look at portfolio rebalancing and reallocating or refilling your stock bucket at a low price when the market's low, or when the market's high. For example, at the end of last year, that'd be a time to take some of the profits from your stocks and rebalance those into your more income investments. And then finally, dollar cost averaging is a very effective approach when you have market turbulence like this. And so, for example, folks that are contributing to their retirement and 401k accounts, you're buying in every paycheck. And so as the market is lower, you're purchasing in at that paycheck at a lower price. So you're essentially buying low. And that's a really good way to cut through the turbulence. And of course, it's impossible to time when the exact bottom is in the market, but that allows you to continue to buy in segments and take advantage if the market does go lower, or be participating when the market does turn back up. Likewise, with clients that have excess cash, this is a good time to possibly look at if some of that should be invested and allocated, and coming up with a plan and strategy on how to do that in a measured form. And then also, with the rise of interest rates we've seen this year, it's presented a tremendous opportunity to start earning some income on your safe investments and your conservative income-oriented investments. And so while a lot of the bank accounts and money markets have not started raising interest rates to keep up with the Fed and the government is doing, we've seen T-bill and short-term bond rates really increase over time. And so that presents an opportunity to earn much more yield on these investment types. Well, I really appreciate you taking the time to join our webinar workshop. I hope everyone found this information helpful. And remember, these are key strategies to successfully weather uncertain times like these and really take control of the situation. And in our view, have an opportunity to come out ahead, especially important as you're approaching retirement. For attending this webinar, we are also offering a free retirement checkup review meeting as a benefit to you, especially for anyone looking to retire in the next 3 years. I do recommend you take us up on this. We'll review all these key financial decisions and strategies specific to your own personal picture and help you make your own retirement decision, both in terms of timeline and how to retire and take income. To take us up on this free complimentary review, you can contact Sean O'Connor from our team. His email and phone number are below. And if you have any colleagues as well that are interested in receiving our Boeing financial planning communications, or getting information about future webinars that we're doing, please let us know and we'd be happy to add them to our communications list too. We'll be providing regular webinars and events like this to cover other important financial topics for Boeing employees. So please stay tuned. And again, reach out to us to schedule that complimentary retirement planning session. Well, thank you again for your time today. We look forward to continue providing good information to you. And please contact us with any questions. Thanks so much.